Good afternoon. I'm Campbell McCrary, Vice President, Capital Markets at Amvest Capital here in New York City. Welcome to the Amvest Capital Inc. live webinar with Altius Minerals. Altius trades on the TSX as ALS, Alpha Lima Sierra, and on the OTCQX as ATUSF, Alpha Tango Utah Sierra Foxtrot. Hope you'll enjoy today's program. It will be available in replay mode. Feel free to chat in your questions in the question pane of the GoToWebinar control panel, or simply email them in. We'll try and ask the questions in real time or after the webinar. Amvest is a New York-based specialist investment management and corporate finance firm focused solely on the natural resource sector. Important note of caution, this call is for informational purposes only. We're very pleased to have with us today Brian F. Dalton, the president and CEO of Altius. He's an entrepreneur in the mining industry and built a successful group of private mineral exploration and exploration service companies prior to co-founding Altius in 1997. His 20 plus years at Altius, he's helped grow the company to an asset base in excess of $500 million through diligent implementation of the prospect generator joint venture business model and royalty acquisition and creation. He's also chairman of the Adventus Zinc Corporation. Again, following the presentation, members of Amvest Capital will ask questions of Brian, and we hope that you will also send in your questions, if many of you have already, and thank you very much for doing that. And Brian, if you want to turn on your webcam, we'll get going. Excellent. All the way from Newfoundland, so they don't get that every day. So very good.
Yeah, thank you again for having us back.
Thank you.
Get that screen out of the way. Well, welcome everybody, and thank you for taking the time to listen to what we have to say here today. I'm going to try to be a little briefer through the presentation than I was the last time. It's not all that long ago, and I've been told that there's a lot of questions, so I'd much rather that format any day of the week. Anyway, and now this is not advancing. Here we go. All right, so for those that weren't part of the last presentation or are not that familiar with the company, Altius is primarily a royalties business that is focused on natural resources. And in particular, our natural resource royalty exposures are aligned with a number of what we feel are the most important macro trends, active in the world today. So to go through those briefly, the first of those would be the fossil fuel to renewable energy transition. In the case of Altius particularly, the way we're exposed is actually quite directly. So a number of years ago, we acquired a portfolio of royalties on some thermal coal generating assets in Alberta, Canada. It was part of a larger transaction that was actually primarily motivated to buy a potash royalty portfolio. But nevertheless, we ended up with these assets, and soon after we acquired them, they were made subject to new regulations that basically signal that they would run for a much shorter period of time than we anticipated. And that put us in the position of looking for a replacement for those assets. And the strategy we landed upon was to take whatever expected revenues were remaining from the coal assets before their regulatory phase out, and to reinvest it into the creation of a new business platform that would basically provide royalty level financing to renewable energy projects, and thereby creating the first ever utility scale renewable energy business. Our largest commodity exposure to our royalties portfolio today is in fact the copper, but more broadly, I think in terms of our base metals, that all are, I think, incredibly well positioned to benefit from coming demand surges that are related to broad electrification and energy storage trends. So this would be, everything from the renewables push, electric vehicles, storage related to renewables, and obviously the batteries and other components that go into electric vehicles. Again, copper is our major exposure, but we also have exposure to a nickel copper cobalt mine in Labrador, and we are investors in a private business that is building a portfolio of lithium royalty assets. The next major trend that we provide exposure to is the push for increased agricultural yield as the world population grows, while the the agricultural base is relatively static, if not shrinking. So there's obviously an increasing demand for higher food yields per area of land. And the way you achieve that is through use of fertilizer. And from an Altius perspective, our exposure is to the natural potash fertilizer, and in particular mines in Canada that produce about a third of the world's potash fertilizer today. These assets are also very unique in the sense that they boast extraordinarily long resource lives, in some cases more than 1,000 years. I'll talk a little bit about this in a second, but to us, that is the clearest indication of the best form of optionality that exists in the royalty business. And that's a case where you've got mines that the operator at their sole expense invests in successively over time to expand production rates. So you become the beneficiary of that extra production without any of the share of the cost. And then finally, we are involved, we have royalty exposure to the iron ore sector, which some might argue sounds strange to be talked about in a list of macro trends that are based around sustainability forces that play in the world today. But what's particular about our iron ore exposure is that it relates to very low impurity iron ore that stems entirely from the Labrador Trough in Canada, which is the single best source of it's the best quality iron ore that's available in the world. And why that matters is that we're seeing a tremendous push that's really just beginning to very much clean the emissions footprint from steel making. This is relatively early compared to some of the other trends, but I'm very confident that it's going to be quite the thematic as we go forward. And when you use very low impurity iron ores, it's a much more efficient reaction in a steel making furnace or other type of production facility. And so there's a lot lower emissions that come from the use of lower emission iron ore. So these are iron ore products that are structurally very much in increased demand relative to the iron ore complex more broadly, and that trend is going to continue and in fact deepen from here. So that gives you hopefully a good snapshot of the types of royalty, natural resource level royalty exposures that we have been working for several years to develop and to provide our shareholders with exposure to. Quick snapshot of, I guess, of recent performance here. For the last number of years, we've shown a nice improvement in royalty revenues. This would show up even more profoundly on a per share basis. In fact, 2020 will break this trend. I think it's fairly certain, and for reasons that really shouldn't be a surprise to anybody. But on a long-term basis, which is very much how we think, we believe that this trend is very solid, and we believe our assets are going to continue to grow and drive higher revenues per share for the long-term future. I also wanted to quickly touch on returns of capital. It's something that we're obviously very focused on. Yes, for the past couple of years, we've been focused on building up assets and growth, either in development stage mining assets or the investments we've been making to build up the renewables business. But we've still managed to continuously grow our dividend as well as increase capital returns through our share buyback. Strong translation to cash flow from our revenues. Obviously, that's a function mainly of the royalty model and the margins that you receive through this business. This slide on the right-hand slide gives you a decent sense, I think, of how our exposures shape up today. You can see that coal and coal at 16%, which is actually much lower than it would have been a few years ago, is declining. Base metals, the major exposure, potash, also a very big piece of what we do. So this is sort of last 9 months revenue. I think the next slide here on a NAV basis gives you a sense of just how long term our exposures are. There's a fair divergence between how our NAV and our short-term revenue profiles look, and this is a function of the ultra-long lives that are attached to some of our portfolio assets. So while some shorter life assets might have a bigger near-term impact, on a net asset value basis, I think you get a better long-term picture. And here you can see what I really consider to be our percentage breakdown, and I think it's very nicely balanced. One thing I will highlight in the bottom left corner here, the net asset value of our renewable royalties since we spoke last has now eclipsed that of our electrical coal royalties, which are declining, while the renewables component is certainly continuing to increase. Right-hand side, a list of some of the major counterparties. For the most part, all very strong, established investment-grade counterparties that are paying royalties to Altius shareholders. This slide, I know it's a little busy, but what it does is it breaks down the expected remaining lives of our portfolio. And if you take it and weight the remaining lives against 2019 revenues, the weighted average remaining life within our portfolio is 121 years, which would be many, many, many decades over beyond the any of our royalty peers, whether they be precious metals, base metals, or other sectors. And I touched on this earlier. This is important, A, because it signals that there is there's an annuity-like element to what we've been able to create over time here. But probably more importantly, it's the clearest indication that you'll find when you're a royalty investor of future option value in the form of a predictor for future expansions. Super long lives just mean that the production rate today is low relative to the total amount of resource that's available. It's always going to be cheaper and more efficient to expand existing mines than to build new ones. So whenever cyclically you get those incentivization conditions that make operators want to build into growing market demand, there's always going to be a preference for brownfield type expansions. So these super long life assets are just so logical as sites for those types of expansions in the future. And the benefit to an Altius shareholder is that instead of getting, say, our royalties from the Rocanville mine for the next 1,430 years, we'd anticipate over time that the production rate will, for example, if it doubled, well, then the remaining life would drop to 700 and whatever number of years that is. So still an extraordinarily long life, and that could be done over and over and over again, and the remaining life would be still far beyond any typical mine out there in the world. This is a really important slide, but if you're a short-term thinker, you probably are yawning at this point. If you're a long-term investor like we are, this should be the slide that gets you the most excited. This is the money slide as far as I'm concerned right here. Another part of our business that's, as Campbell mentioned at the outset, that really goes back right to our roots. We started our business as a less than $1 million market cap junior explorer, a bunch of kids studying geology in university. And we were early innovators of a business model that's now referred to as project generation, which simply means that we go out and we generate our own mineral exploration projects. And rather than trying to test and bring all these projects forward through discovery and development ourselves, we are fairly rigorous about farming those opportunities out to other junior and senior companies under structures that allow us to retain either minority project interests or, more commonly these days for us, equity positions in the juniors that we vend the projects into, and always retention of royalties. So back in 2014, 2015, in the depths of the bear market for mining, when there was no capital available to the junior sector, at great odds with today. And even the mining companies at that point, their operating margins were so low that they had, basically cut exploration to zero. It's always the first thing to go when things get tight. And for us, that was a signal to get busy, and we were able to build up huge land portfolios in many key districts around the world. And since that time, we've been able to vend out 60 separate projects for different equity positions and royalties. The value of those junior equity positions today is around about $50 million. It's been building up, but as far as signals go as to what that portfolio might ultimately produce for us, in addition, obviously, to success on any of the projects that we hold royalties on that would go right to our cash fund royalty portfolio, we're looking for signals along a cyclical path that will ultimately lead to, significant wins and monetization opportunities for Altius shareholders. In the previous mining cycle, a few millions of dollars in investment at the ground level was ultimately translated into more than $200 million in capital gains by doing exactly what we're doing right here. I would argue that our positioning for this cycle is even stronger than in the previous cycle. One great signal that we saw this year as capital began to return to the junior mining sector was a disproportionate access to capital for the companies that are within our portfolio. So the companies that we're major shareholders of and that are largely rooted on the projects that we created and brought to them. That portfolio collectively has raised over $140 million in 2020. So it's fighting way outside of its weight in that regard. And this is a signal forward of a tremendous amount of drilling and news and feasibility results and all sorts of possible catalyst type events within these companies that they're now fully funded for, that will ultimately result in, I'm sure, some significant wins for Altius and its shareholders. I'll wrap up the formal presentation, part of the presentation, with a description of Altius Renewable Royalties. This has probably been the area where there's been the most development since we spoke last on this forum. Again, I guess I gave a little bit of an overview of how the business came about and how it's the product of us choosing to strategically try to replace our declining coal assets with a new and innovative royalty platform for the renewable energy sector. When we last spoke, we just completed our second investment with a significant US-based developer attached to a portfolio of about 20 gigawatts of development projects that they held. And I would have been signaling then that we were starting to see real take-up within the sector and an acceleration of deal flow, and greater just a sense that the concept that we were trying to bring to the sector was catching on. What we were also feeling at that time was that not only was this opportunity going to be go well beyond what we knew we needed to invest to replace the declining coal assets, but that in fact it could be much bigger and was probably going to be beyond what Altius Minerals would be able to fund, using cash flows with existing assets and whatnot. So for most of the summer, we embarked on a search to attract a significant strategic partner, and that culminated last month with an announcement that Apollo Funds has agreed to earn a 50% interest in the underlying operating business that we've created called Great Bay Renewables. So they're investing the next 80 million on top of our 60 million or so invested to date to earn a 50% interest, following which we will be equal partners, funding partners going forward. I won't go deeper on the details. There's lots that we've spoken about in the past month since this transaction. So if there's questions about the finer points of the transaction, I'm happy to go through that. But generally speaking, that the choice of Apollo was based on a like-mindedness that we didn't see elsewhere. I mean, our search wasn't overly broad. We were fairly careful about not opening up the kimono, so to speak, too broadly. But we did speak with some pension funds, private equity, more traditional funds. And what stood out about Apollo was just how like-minded they were about how much evolution was likely to occur in the near term in terms of how the renewables energy sector was going to fund and finance itself. It's a sector that hasn't actually evolved much, or the financing structures within renewables haven't evolved much for quite some time. But I think we and Apollo both agree that there is a big evolution about to come, and so together, what we're doing in this partnership is positioning ourselves to capture holes that are going to get created as that evolution happens. And obviously, the backdrop here is a strong one. It seems to me that every jurisdiction's planned economic stimulus response to events of this past year involve infrastructure, and then more particularly infrastructure that relates to the sustainability transitions, whether it be grid investments, electric vehicle infrastructure, or just renewable energy more broadly. So I believe we found ourselves in pretty much straight in the crosshairs of an enormous pending unleashment of capital from both public and private sector sources. The transaction, the amount that was invested or that Apollo will invest or earn their interest did generate, it's an accretive investment amount, but it wasn't the primary consideration for us. There were, in fact, offers that we could have taken that would have created a higher mark, but it would have been not, as in our view anyway, would not have been as beneficial in the long term for an Altius shareholder if we'd approached it that way. And it's the key here to remember is that this deal with Apollo wasn't about divestment for us. This was about bringing on and adding because we intend to continue to be part of the growth of this business. If it had been more of a divestment sales type structure, sure, we would have taken the highest bid. But what we wanted was the right combination and partnership to really capture this opportunity going forward. Again, a little more backdrop on the sector generally. I think this is probably becoming common knowledge to most people, but there's been a remarkable shift in the past few years such that renewable energy now works on an unsubsidized basis and outcompetes other traditional sources. And it's really just been a function of R&D successes as well as a general scaling up of the sector. But right now, if you're looking to create new generation capacity, and if you're not selecting renewables as your choice, you're not making an economic decision, which is, this is a big shift. It's not about this being some type of social type imperative anymore. This is fully backed by the forces of the free market and capital. Other trends to watch for that are linked here, things that you'll start to see, the limiting factor to how far renewable energy can go in terms of the amount of the grid that it can occupy are obviously limited today by its intermittency. You need other less intermittent forms of power on the grid. But one thing we're definitely seeing happen very quickly is that pretty much all new renewable energy projects that are being proposed today with storage attached, compared to 2 years ago when almost none would have. So once you put storage on these sites, the amount of the grid that they can occupy goes up pretty dramatically because you've essentially solved most of the intermittency issue there. So I know it's been a fast-growing sector, but I really think this is just the starting gun has really only gotten off here. Won't go through this slide, but it's available on our website. It just gives the background and history of the development of our renewable energy platform, beginning with trying to figure out how to even create royalties for the renewable sector and how to make more traditional natural resource royalty structures work in a somewhat unique subsector of natural resources, and then culminating with the recent endorsement and investment by Apollo. The two major investments that we've made to date are with Apex and TGE. This is just a quick snapshot that talks about the reach that we're gaining through these investments. Through Apex, we have royalty level exposure to a 21 gigawatt portfolio that's well diversified by geography within the US anyway, and also by technology type, both wind and solar. And Tri Global, a smaller outfit, but still both of these companies are ranked as in the top 5 of renewable energy originators and developers in the United States. So we're definitely attracting the right types of partners, and that's a key word here. The best salespeople we have right now for what we're offering, when we talk to new potential developer companies that we might invest in, we encourage them to talk to Tri Global and Apex right away, because what they'll hear is that this product is partner-like capital that has really allowed them to, in a flexible way that's necessary when you're a project developer and originator, to grow their businesses, to increase the pace of the sale of the projects onto final owners, as well as to expand their own project level portfolios faster than they could have otherwise. So it's always nice when your best champions are your customers. This goes to what I said earlier, just highlights what is coming in the market. There is a decline in application for fossil fuel and nuclear-based generation in the market. There's a dramatic increase in application for renewable storage type project development. This isn't will it happen, it's happening. Market-wise, this is being recognized. I think you know, the shifts that are being encouraged here and that are being fueled with stimulus, economic stimulus post recovery of the pandemic. You know, you're starting to see a lot of rotation in capital markets and investment moving towards renewable energy businesses at the expense, really, of more traditional types of energy producers. So, you know, again, I think it's one of those sectors that's emerged as a real leader, and probably we'll look back on 2020 as a really pivotal turning point of when you know, this business really went mainstream. It's like that photo that you see all the time of the one horse and all the cars. Well, that was the year in between those two photographs when it comes to the energy complex, is probably 2020. I show a slide here that talks about valuations as well. Obviously, renewable operators have done very well. We're building a royalty level exposure to the renewable energy sector, and quite a direct one. In every other natural resource sector, there is a significant premium that gets applied to royalty level exposures over operating level exposures, and that's, you know, it's well understood, and the reasons for it prove out over time. What I'm highlighting here is that today renewables operating businesses are more highly valued than any of the other natural resource peers that we're aware of. In fact, with the exception of gold royalty companies, operator level businesses in renewables, you know, attract this, you know, a higher valuation than most of the royalty level plays, including for diversified mining companies. So my point here is that there's a higher valuation today for renewable operating companies than there is for our diversified mining royalty business. And really, as in terms of attesting in the market of what a renewable royalty business might trade at, and if it attracts a premium over its operating level peers, hasn't really been tested. Which goes to some thinking, I guess, that's underway within Altius right now about how we go forward with this business, and how we, in particular, after Apollo completes their earn-in, should be funding our business going forward, funding our share of the investments post that Apollo earn-in amount. Now, no decision has been made on this front. We have a few options before us. They include obviously continuing to fund from the parent level, but I think there's practical limits to that, as I discussed earlier. Another is we attract additional private strategic capital. And the third is that we have an opportunity potentially to take ARR and to list it as a pure play public company and to see what, to really test the market. And if that were successful and it were to attract the valuation that we think it could, it creates a means for us to really mitigate dilution on behalf of current Altius shareholders and to contribute on a toe-to-toe basis with someone the size of Apollo and fully capture this opportunity going forward. So I guess that was somewhat leading, but I do caution that this is a board level decision and all of these different considerations have pros and cons that are being weighed right now. But it's just a common question that we get. How do you keep up with Apollo post the earn-in? And really what I'm trying to say is that we're very busy on solving that equation right now, and we'd hope to have more to say in the coming months as our board works through the options and weighs all the pros and cons. So I'll stop there, and maybe we'll turn this into a bit of a lively Q&A session now.
Sure. So I have a few questions that came in from the same person, and embedded is a statement. So they're basically his words, so you can comment on that, and then he sort of has a dangled question at the end. But so anyway, but they represent very good sentiments from certain people in the market. So regarding the Cami sale to Champion, the most plausible reason for Champion purchasing Cami is to get across the very finite port capacity that Alderon has in order to facilitate their own current expansion. This would leave any possible future Cami development without port access. Instead of being a positive for Altius, this seems to have placed a large impediment in the way of developing Cami in any reasonable time frame. In addition, why would Champion develop Cami lands on which they have to pay a 3% royalty ahead of their own substantial resources that are not subject to a royalty? So his words.
I might have to get you to repeat some of that. There's a lot of parts there, but
yeah.
So the first part was
basic.
I guess the first part of that was a bit of a suggestion that Champion did not buy the Cami project yesterday for purposes of potential development, but instead saw that the Cami project had port access secured, and then that could be applied to their existing operations next door at Cologne Lake. And my simple answer to that one is no disrespect, but it makes absolutely no sense. There's a precedent transaction, a very recent one in the market, where similar amounts of port access were acquired for less than $4 million, I believe. Whereas yesterday, Champion committed closer to $40 million to buy the Cami project and spoke quite clearly that they are attracted to the optionality. They're jumping right into updated feasibility work and synergy studies, and they're considering it as a platform for growth going forward. So I've heard that comment a couple of times in the past couple of days, but it's again, it really doesn't hold up. You wouldn't pay $30 or $40 million to buy port access when you could turn around and buy it for 3 or 4 if that was your real objective. What was the next part? You'll have to help me now.
Okay, sure. So why would Champion develop Cami lands on which they have to pay a 3% royalty ahead of their own substantial resources that are not subject to a royalty?
Right. Yeah, it's true. Well, Champion announced last week that they're actually expanding their current production levels from their own resources from 8 to 16 million tons. And quite frankly, that is going to probably represent a limit and a constraint. There's only so much you can do at the site. You've got limitations and working phases and all sorts of challenges there. The other factor that I don't want to make this too complex, that could motivate them to preferentially develop Cami Alderon beyond just alleviating space bottlenecks, is that the Kami ores have a slightly different chemistry than the Bloom Lake ores. There's a higher magnetite content in those ores. And Champion has been working pretty proactively and talking pretty proactively about how they're beginning to produce customized products for different customers. And one of the areas that's most short in the market today would be for pellet feed related to direct reduction furnaces. So these are steel plants that essentially use no metallurgical coal in the steel making process, which is, I expect, where the entire market is going to be in very short order. The Kami ores are incredibly well suited to produce that type of material. So it may just be reflecting feedback they're getting from their own customers about what market demands that they have. And the 3% royalty, again, normalized prices here, you're probably talking about $3 or $4 a ton as an incremental cost. They just bought this asset yesterday for 30 or 40 and inherited probably close to $300 million in some cost. I think it's a pretty good trade.
Okay. Renewable royalties. It was indicated in the recent past that the renewables royalties were likely to garner a return on investment for Altius in the region of 10 to 12% per annum. Given that Altius borrowing costs are about 5%, let's say, the renewables business model seems to give a net return of 5 to 7% per annum before G&A and other overheads and corporation tax. Frankly, his words, this seems to be a relatively meager return, and the limited prospects of this model seem to have been confirmed by the recently announced deal with Apollo, who paid no premium whatsoever, a minimal one, to become a 50% partner. In other words, I don't see a value put on the deal besides beyond capital introduced. So am I missing something?
Right.
Yep.
Excellent question. This person must definitely not be a gold royalty company investor. So 10 to 12 seems pretty good against ones and twos for the most part, if you ask me. But there's something else that needs to be factored in here. Well, two things really. First and foremost, that's a base case and pretty baked return profile. It doesn't go to all of the forms of future option values that can juice those returns, and these are the kinds of typical option values that we get through the royalty business model. So expansions, potential future green credits, all sorts of things that can come in that would enhance that overall return. And it really doesn't work the other way, because these are all investments that are borne fully by operators typically, and we tend to be, as royalty holders, we get to be a free beneficiary. So it is true lopsided option value. So 10 to 12 is the base, then it builds over time. The other thing I think is really worth pointing out is that we're getting these 10 and 12% type returns, and they're on development stage projects. In relatively short order, these are going to become production stage assets. At that point in time, renewable energy assets are trading hands today with sort of IRR expectations of between, say, 3 and 5%. So as these royalties go from royalties on development stage assets to assets on production stage assets, top line level exposures, there's an amazing arbitrage that happens here. So instead of being discounted at 10s and 12s, which is our, the entry level that we've come in at, the same interest revalue with tons and tons of market participants setting these shifts, by as much as 100 to 200%, all in relatively short order. I think those are the two key points I would argue there. 10 to 12 is the base, then there's option value, and then in the short term there's a huge asset level value arbitrage that happens as these things knock off and reach that production point where they have a PPA, when every single pension fund, utility, infrastructure fund on Earth is competing to buy them.
Okay. Prospect generation portfolio. Can you discuss specifically any of the investments in the portfolio that may be game changers for Altius, and that they can move the market cap needle, or better yet, share price in a meaningful way?
Kind of like asking me which of my children I like best. But there are a good number of positions in the business. I think they're all, because we helped create them and mentored them, they're well-run businesses, and they've already shown a clear signal this year in the outsized amount of capital we've been able to attract. I can't easily predict which of those will ultimately be the big successes. Some of these companies are going to have discoveries. They're going to either build mines or get taken over. The minute I try to guess which ones they'll be, I'm sure, you know, I'll recount that it was the ones that we thought that we would have handicapped with the highest probabilities that will be the disappointments, and it'll be the others that are successes. I point back to our last cycle where we had a similar structured portfolio, and you know, in the end, it was 2 or 3 stories that emerged that became true market leaders. 3 of the companies, I believe, ended up with higher market caps than Altius did, and we were able to monetize and make huge cash profits, which we then redeployed and turned into cash flowing royalties soon after. But if I got really pinned down and had to pick today, Adventus, which is Ecuador focused, has one project that's quite advanced stage, very high grade. From all technical appearances, this should be developed in super high margin, high return operation. They've just raised a substantial amount of capital, all from pretty sophisticated institutional investors, to finish a feasibility study. So we're the biggest shareholder of Adventus on one hand, and we also own a royalty on that project. I'm also excited about an interest that we hold in a company called Origin Royalties, and even though we're not precious metals royalties focused, they are. And they have one royalty that is on a project that's currently being advanced to develop. It will probably be a cash gold royalty by next year. But even more exciting for me is the royalty that they hold on a project called Silicon in Nevada. This is an Anglo Gold Ashanti project. They haven't said a ton about it, but what they have said is that it's a substantial discovery, and if the rumor mill is even close to being accurate, this is a very major new gold discovery in Nevada, and they hold a royalty on it that, you know, I think once the full scope of that discovery, if it does live up to hype and rumor, is unveiled, it's a game changer. I know of another little gold royalty company that happened to own a royalty on a big gold discovery in Nevada. That worked out pretty well for them. I think they were called Franco Nevada or something. But anyway, we're a long ways from there on that story. It's just exciting to think about. There's no place in the world that any precious metals royalty company would rather have a discovery happen than on a project in Nevada that they hold a royalty on. Slight aside there, but not immaterial. So Origin owns a 1% royalty on that project. Altius also retains direct 1.5% royalty. So we're the major shareholder of Origin. We own a royalty, indirect royalty exposure that way, but we also own a direct royalty there. So yeah, that's one that, who knows, it'll be a company that I haven't mentioned that tomorrow will announce a big drill hole and boom, that's the one. But if I had to call today based on what I see, these are 2 already potential economic discoveries that are sitting within our portfolio that are yet to get revalued.
Okay, thank you. Gabe?
Thank you. Brian, so I know you've touched a little bit on that you're in discussions at the board level about what to do with the renewables piece, but is there a current budget allocation for that that you can guide to for the balance of the year, the first quarter, or before you make that decision?
Are you asking about what we'll invest in figuring out what to do, or
just more about like what sort of budget do you have allocated to the renewables business today?
Oh, well, in the near term, I guess we're off the hook. It's obviously been probably the most significant part of our overall capital allocation strategy for the past few years. But right now, Apollo is funding everything. So the way the deal works is that they spend the next 80 million to catch up. In fact, we made our first investment post that joint venture formation. I guess it would have been maybe a couple of weeks ago now. We made another new $25 million investment. But Apollo was funding all G&A, any investments until they reached that 80. So we're on a little bit of a holiday as far as our funding needs and the ARR goal. And it's that holiday period that we're so focused on in terms of figuring out how ARR will fund its share post Apollo. But for now, we've gotten our first break in a few years from almost frantic level business development and investing to get ARR launched and keep it sort of in that first mover position.
And how long is that holiday period, roughly?
Well, it's obviously going to be a function of the pace of deal flow and deployment. The deal flow is very strong right now, but that doesn't necessarily mean everything is going to conclude, or it doesn't speak to how long it takes to get deals across the line, which always seems to take longer than you think. But from a preparation point of view and making sure that we have our decisions about how we'll fund, basically the earliest we think we'll need to be prepared for that eventuality is Q1. We don't anticipate they'll get past that number before the end of the year. If they do, we'll be caught with our pants down a little bit, but we'll figure it out.
Okay. And then in terms of Altius sort of going forward, what do you see as the new projects or the new commodities, the revenue mix? Can you comment on that?
I really like where we're positioned right now. This was a bunch of work that was done in 2014, 2015, and 2016. It was quite purposeful in terms of how it tried to establish our portfolio mix. And for the past few years, we've been addressing some of the inherited challenges that came with those portfolio purchases, whether it be the fact that 777 copper zinc mine will go down in a couple of years, and getting that replaced first with Chapada, and then things like Curipamba, patching that hole and making sure that we're actually looking at a growth profile in the base metal business, and obviously more dramatically the whole reinvestment of coal into renewables. But again, like potash has turned the corner here. Prices have turned up again. Supply demand balance has been reestablished. Huge demand right now after a couple of bad growing seasons. Things have normalized again. Copper, we're hitting low threes here now with only growing demand expectations, and another year of no incentive conditions to bring on new supply. Just stretching out those, how those curves are going to cross, the perfect storm that we think is coming. I already touched on the iron ore side. Structurally within that overall iron ore complex, the positioning we have is absolutely directed at where the market is heading. There's not much I'd change here. There's nothing I look at and say, oh, we're really missing this, or we're overweight here. It's a lot of that work has been done. Again, I feel like we're going into this cycle that's just beginning here now. Probably much further along than I could have ever guessed 5 years ago we would be in the evolution of the portfolio.
Understood. Just a question that came in terms of uranium. Do you see any interest in that sector or in commodities that are not as saturated as gold, for example, like battery materials, etc.?
We would typically steer clear of more not as widely traded commodities, more specialty type metals. Now I know uranium is kind of on the bubble there. It's a decent sized market. Lithium, quite frankly, is a tiny market. We've been in some of those before, and they tend to be challenging, for want of a better word. That said, we are actually invested in lithium, but it's not because of the scale of the market that today. It's a belief that we have that lithium will continue to grow in importance and will work its way up onto that list of the more broadly traded metals. So we've been doing a lot of groundwork there and investing in projects through a private vehicle called Lithium Royalty Corporation. So we've been laying in some bets for the last couple of years, ever since the lithium market, sort of the equities market, lost its froth. We've been jumping in, stepping in, and backing what we think are the better technical stories. So that one we're involved with. Uranium, I'm probably not going to be popular with some friends for what I'm about to say here, but to be fully honest with you, even though I get it and I understand its attributes and its it's the role that it can play in all of these transitions that are underway, it doesn't change the fact that if you want to go through the list of things that an ESG investor or an ESG passive money fund considers a negative screen, nuclear ranks up there with tobacco right now. Whether that's deserved or right or wrong, I don't know, but I just feel that capital is not in any mood at this point in time to head towards the nuclear build-out sector, the nuclear sector. So I'm having a hard time rationing, at least in any kind of reasonable time frame, how that translates into a lot of demand. Like one area where uranium is actually one of the areas that we've made most of our money in our history. As an explorer, we made a big discovery of uranium, and it turned into, again, one of our biggest successes. The other thing to point out there is that when I look back to that last market cycle, when all the commodity sectors, were hot before it was all said and done, every exploration subsector was able to attract capital. So loads and loads of money were poured into the ground looking for new copper deposits, uranium deposits, nickel deposits. And realistically, when I look back on it, the only subcomponent there that actually had success was the uranium exploration sector. There were discoveries made in the last cycle that are mind-boggling, to the point that they represent better than the deposits that are currently in production for the most part. So, it's not a scarcity factor. We're not exploring for uranium because we just don't think it's at all realistic to imagine that we can make a deposit that will outcompete some of what's already found and undeveloped right now. Anyway, beyond that, you're looking at stealth growth in the nuclear sector from markets such as China and otherwise. But in Western economies, the capital markets, at least at this point in time, you're better off pushing a coal story, rightly or wrongly.
Sure. I appreciate the candor. Thank you.
I have a problem with candor sometimes, too much of it.
Brian, may I ask you to repeat what kind of project you count as a clean iron ore, and is Kami one of those Kami project?
Yeah, so one of the big things that accompanied the growth of iron ore production in Australia over the past 15 years or so, there's a sense out there that iron ore was essentially doomed because Australia could just bring it on, and to a lesser extent Brazil. But there was a crack in that argument because the deposits that were available for development and that have been newly developed are considerably inferior from a quality perspective relative to the ores that had been normally mined in Australia. And so it's introduced issues in the market. This has come at the same time that there's been more of a push, China and elsewhere, towards reducing the emissions footprint of the steelmaking process. So you've got this divergence going on. The reality is that unless you use very pure iron ore, you're running a very inefficient reaction in a steel plant. If you've got a lot of impurities, whether it's silica, phosphorus, alumina, what happens is that the steel transformation process, the reaction becomes incredibly inefficient. You have to pile in more thermal or metallurgical coal The reaction doesn't run as well. The mills get beat up a lot, a lot more. So basically, it's just it's a high polluting process when you run impure forms of iron ore. And en masse, incremental iron ore production is less and less pure. The Labrador Trough and the Kami project stand in quite a contrast here. This is the purest remaining source of iron ore that exists. So ultra low level of silica, alumina, phos. Just to give you an example, the neighboring project in Labrador is called the IOC mine, and Rio Tinto is the primary operator. For the last 5 or 6 years, they've talked about selling that asset because it's not part of their big Australian complex, it's non-core, and they ran a couple of processes even, and it's a bit of a bias in terms of their scale and whatnot that they try to achieve in their Australian operations. But again, decidedly non-core. And then in September, I catch an announcement that they've now opened up a facility in North China, Rio Tinto has, in which they're taking in IOC ultra high quality ores and blending them with incremental product coming out of Australia that doesn't meet environmental or quality spec and can't be sold. So it's gone from suddenly being non-core to being almost instrumental or it's what makes some of their Australian product even saleable all of a sudden. I mean, this is a remarkable shift in a very, very short period of time. And the market is very much going towards higher quality inputs because the cost of the emissions of using low quality materials is becoming prohibitive. So again, highly focused on the structural shift towards higher quality. And there's going to be technological shifts coming with this as well. Honestly believe that there's a day coming, that's foreseeable, in which metallurgical coal isn't used in steelmaking anymore. I'd have been laughed out of any room in the world 3 years ago saying that. And I might still be, but I'm right.
Yeah. Thank you.
Moving into gold for a second, are you generally satisfied that you are pulling out of the precious metals royalty space? And on the other side, someone suggested maybe spinning out into a gold into a separate company. So just any thoughts?
Yeah, we're not anti-precious metals at all. I mean, we have no issue with owning gold royalties. It's just that to be buyers of them, we'd be competing with a whole host of precious metals royalty companies that have return expectations that are, sometimes in the low single digits, and we just can't bring ourselves to that. So we've decided to focus where the crowd isn't and to build up, this base bulk commodity and other natural resource royalty business. It's not an anti-precious metals bias at all. And in fact, in our project generation business, there's actually a disproportionate amount of effort that goes into gold exploration. So it's one of the primary focuses of that business. And, let me explain there, because one big function of our project generation business is to ultimately create pipeline royalties that will be the longer term development royalties within our portfolio. In the case of gold, though, we can't ignore the fact that there's a huge market for royalties on gold projects. So if we end up with a royalty on a significant gold project, it's unlikely that we would retain it. There's a tremendous difference in how these things are valued relative to how our business is valued today. 2-3 orders, multiple really times kinds of valuations. So we've made quite a lot of money over the years in building up gold royalty and other types of gold interests, and then selling them on to those higher value businesses, and then taking those profits, those higher returns, and dropping them back into higher fundamentally returning and yielding non-precious metals. We love the gold royalty business, but we're sellers to it, not buyers.
Very quickly, we can get through almost everything. Share buyback, your thoughts, policy, future potential?
you know, at these prices, come on with it, we'll take them all. But you know, we are not uncapital constrained, if that's the proper phrase. For the past couple of years, we've had to balance a few things, and a big part of it has been getting this renewables energy business launched, and that's taken a lot of focus. That said, we have been increasing our dividend, and we've been pretty busy on our buyback. I don't know what the 12-month, I think in our last quarter, we announced that we've acquired 650,000 or so shares year to date against 40 or so million outstanding. So you know, we bought, that was more than that last year. We've been buying back, you know, 1 to 2% of the business every year in addition to growing our dividend. It doesn't help that we get different arguments there. We've been at this for 23 years. We have just over 40 million shares outstanding. We've never done a rollback. And we get a differing argument sometimes that is a negative because it's our liquidity. I mean, I think Warren Buffett would argue with the whole concept there, but you know, it is a viewpoint. For me, it's straightforward. Buybacks are just another potential competing investment opportunity. And if I know that our assets are cheaper than the next best investment opportunity based on their market pricing, well, we're going to hit it to the full extent that we can.
Okay.
And we have it. So our money's where our mouth is in this one.
I have a 3-part question about the Apollo deal, but if we can, this will be our last one, and then let's close. We're over time. But how do you plan to fund the 50% match up to $60 million US from Altius with Apollo to maintain the ARR, annual recurring revenue? And then longer term, how will the investment in ARR benefit shareholders, spin-off, IPO, etc.?
So I guess I've touched on how we intend to fund. That's the process that we're figuring out right now. The options, simply put, are continue to fund with, you know, allocating cash flows from the parent, raising capital privately within that substructure, or taking that subsidiary public and raising capital publicly, or some combination of the above. But that is the process that's currently underway. And the other part of that is, how does this translate into back to value for Altius shareholders?
How will the investment in ARR benefit shareholders, spin-off, IPO, etc.? Is there an end game to that?
Well, to the extent that the choice is to go with the IPO, the objective would be to gain a valuation for that business that is at least in line with that of the operating level peers in the renewable sector. And there's actually, you know, that's quite accretive. They receive a higher valuation today than Altius, the minerals royalty business does. And so how that helps a shareholder is that it would mean that equity capital in that case could be raised less dilutively than if we were, say, to raise capital when Altius Minerals was flowing into the sub. So there's an element of the pure play that renewables represents, for obvious alignment with various, you know, capital flows that are largely ESG focused these days. So our objective is obviously to continue to be participants in the growth, and to the extent that that doesn't mean we stay toe-to-toe investing dollar per dollar with Apollo, our job has to be to minimize dilution of assets as best we can, or dilution of ownership at an Altius shareholder level. So the way you achieve that is through, potentially one way to achieve that is by testing whether or not a renewables royalty business would find a cheaper equity cost of capital in the market than Altius, the parent, does today. That's a big debate, and one that, you know, again, we'll make our call on in very short order here.
Okay, thank you. Thank you everyone for tuning in, and please, you can follow Altius Minerals and Amvest Capital if you want on LinkedIn and Twitter, and appreciate all the great questions. If we didn't get to it, or you still want to learn more, email, and we'll put you in touch with Brian. So Brian, with that, a closing brief remark. No, you can, and we'll close. Thank you.
I could really annoy everybody and say patience again, but look, we're at that point. Things are turning. We can all see it. We all know what sectors are about to be the places you want to be, and just look at how we're positioned. We're there in every front. Our day is nigh.
All right. Thank you. Good night, everyone.
Thank you.
Thank you. Good evening.